You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Options Bootcamp is brought to you by tastytrade. Ready to shred your paper trades? Then trade at tastytrade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. tastytrade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, welcome back to Options Boot Camp for the first time in the mad new year of 2025. Hope your holidays, hope the new year is treating you well. I want to thank all of you out there who helped to make 2024 such a wild year for the network here. New folks discovering the content all the time, whether you download, stream, subscribe, listen, rated, reviewed, whatever you did to engage with our content last year. We thank you all for making 2024 such a great year for the network. Hope you had a great year as well. And we're looking forward to another great year here in 2025 on the old OBC. Of course, if you want to go above and beyond, you want to join us for some other great exclusive content, only place to get it, theoptionsinsider.com/pro. I want to welcome again all the folks who joined us over the holiday season. Great to see so many new names joining us over there on the old pro. Theoptionsinsider.com/pro is the place to go to learn more as we learn who's joining us for the first time in 2025. Yes, the streak is alive. I am pleased to be joined once again by our old pal, Mr. Dan Passarelli, the black-hatted one himself from Market Taker Mentoring. Mr. P, welcome back to OBC for the first time in 2025, sir.
Happy New Year, Mark, and Happy New Year, listeners. It's good to be back in the saddle in the year of our Lord, 2025. Got lots of great stuff to talk about. It's going to be a good year.
It is going to be a good year. You know how we kick off a good year, Dan? By looking back on a wild year with a little bit of 2024 year in review. Here we go. All right, everybody, welcome to a little bit of year in review. We can't go forward until we go back a little bit, listeners. And man, what a wild year 2024 was from just about any definition. You look at it from an overall market perspective, valuation perspective, obviously it was another banger year there. Market carried north on the backs of AI and the hopes for rate cuts. We didn't really see the rate cuts, or at least as many of them, come to pass as the market was pricing in at the beginning of the year. Didn't stop the rally, though. Markets, at least in the broad equity space, mostly green last year. A lot of other themes kind of taking over the market last year. I have some numbers I want to crunch from last year as well. Before we get there, Dan, when you look back on 2024, give us one, just one, we'll get to more. Give us one of the themes, the trades, the trends, the developments that really stand out to you as you look back on last year, sir.
Oh man, I've got a few in mind. But I mean, the one is just the sort of forest view instead of the tree view. And it was amazing that the market was just up and up and up, for some good reasons and some bad reasons. But, as an option trader, a lot of times I look at that and I say, oh, well, that's probably a good opportunity to sell puts. But even though implied volatility was high across the board, geez, I mean, with a lot of these stocks, buying or selling puts was like not even the way to do it. It's just buy the shares and just go.
That is heresy to say such a thing on an options podcast, sir. How dare you? We don't buy shares here. What are we, laymen? Just cavemen. All we can do is buy shares, sir. What are we talking about?
I know it is kind of sacrilege.
I'm going to mute you for the rest of the show in punishment here. But you know what, listeners? It was a wild year from an options perspective. A lot of things to get to. Let's start, Dan, with some cold, hard numbers. How about that? You might be wondering, how did the year end up in December? How was December? I mean, we've been tracking the volume trend all year. It's been pretty strong all year. How did December wind up? And then, of course, more importantly, how did the year end up? And December, Dan, usually a quiet, a sleepy period in the markets. This past December, not so much, listeners. 1.1 billion contracts changing hands in December of 2024. That is a pretty wild month, especially for the end of the year. That is about 20% higher than December from the year previous. That was 916 million. That was already a pretty impressive number in 2023. Gaining 20% on that is no mean feat. The future's up 11%. Index options up 6.1%. ETF options up 11.5%. Equity options up nearly 30% in December of this past year. So that's kind of wild seeing such hot numbers in the month of December. And you might say, what's the big deal? But the entire industry, listeners, not that long ago, I would say leading into the pandemic, 2017, 2018, heading into 2019, the entire options market, the entire industry, every contract traded in the year added up to a sum total 4.5 billion contracts in the entire year. Now we have 1.1 billion contracts changing hands just in the month of December when people are out and about and doing other things other than trading. That's kind of wild to me, Dan. Are you surprised at just how robust December was to end the year, sir?
Yeah, I mean, I remember looking, 10 years ago, 15 years ago, 20 years ago, being excited about a much smaller level. And, for people who think, $1 billion or a billion contracts, that's not that much. Think about what that means in terms of notional value. Each contract represents 100 shares times. So it's a billion contract or 1.1 was it times 100 times the strike price, because that's really what you're controlling is 100 shares at that strike price. Like now we're getting into just freaking mind-boggling numbers.
Yeah, Dan, I just pulled it up. The numbers for 2017 from our friends over there at OCC, and they were very proud of this. The entire industry was proud of this. They were trumpeting that total 2017 volume, Dan. 4.3 billion contracts, the highest ever 4% increase from the 4.1 they put up in 2016, the year before. Now, Dan, 1.1 billion just in December. I mean, it's kind of wild. We're talking about a completely different game, Dan. Here we are in 2024 and 2025 than we were back not that long ago, 2017, 2018. It's kind of wild. Speaking of wild, listeners, was it a wild year from an overall options volume perspective? The answer, once again, yes. Total volume on the year, that includes everything, listeners. That includes futures and everything. 12.2 billion with a B. 12.2 billion contracts. Again, 4.3 billion in 2017. 12.2. You see why people who've been doing options for a little bit are still kind of just shell-shocked, at gobsmacked, whatever adjective you want, throw in there, at these just wild volume numbers, listen, because they are pretty wild. So that's up 10.6% from an already impressive 11.1 billion in 2023. Dan, other highlights, the futures, which again are mostly VIX futures, a couple other things sneaking in there now, but mostly VIX futures, up 7.7%, 60 million of those changing hands. Index options, again, Dan, all this drumbeat has been on, the entire market's been carried on the back of 0-day in the indexes. And last year, that was actually kind of true. It was a little bit concerning, actually, when we were crunching these numbers a year ago. Single name equities were kind of flat. 0-day was where all the growth was coming from in the equity, or in the index options. This year, index options are strong, 8.9%, but they're not carrying the whole thing. ETF options, kind of the laggard this past year, only 4.1%. The big banger, the big gainer last year, Dan, equity options, up 16.1%. So kind of a reversal of the trend that we saw in 2023. And kind of interesting, Dan, what are your thoughts on the overall explosion of volume continuing, nearly 12.3 billion contracts last year, and also the fact that a lot of that being carried back on the old single name equity, sir?
Yeah, honestly, I find it pretty interesting because when we think about 0DT stuff, and we give that its credit where credit is due as far as adding to volume, that's indexes and ETFs, but equities actually picked up more steam than indexes and ETFs. So it's really kind of interesting on that level. It's also interesting of like, where is this volume coming from? I think a lot of it is existing option traders as opposed to new entrants into options. I think that there's a little bit of truth to that. So yeah, it's when you look at these numbers, they tell quite a story.
I just pulled up the numbers, Dan, for 2023, and equity options 5.6 million, pretty much exactly unchanged, up about 0.5% from 2022. So that concerned a lot of people, including me, that maybe this retail explosion we've been talking about, it had been carrying the markets on its back, kind of was whimpering out, Dan, coming into 2024, and all the action was in index options, 0DTE taking over. They were up 33% in 2023. We saw kind of a reversal of that this year. 0-day, the index is still strong, obviously up 9%, but equity options coming back to life, which I think, Dan, some of that can maybe also be pointed to, if there was another theme coming out of 2024 from an options and overall market perspective, it was, especially in Q2, maybe early Q3, the rise, the return, the revenge, if you will, of the meme stocks. Of course, we saw this roaring kitty nonsense last year, started ginning up a lot of action in some of these names that have been kind of dormant, like GameStop. We saw some other paper and some of these names that was very much reminiscent of 2021 and the meme stock craze again. We saw call skew getting bid up in some of these single names to ridiculous levels. Listen to some of our unusual activity shows if you want to hear examples of that for yourselves, listeners. But people trading calls on strikes that are just for ridiculous prices, far, far out of the money. And also, as a side note, another kind of disturbing trend I noticed last year along these same lines was people buying calls, like let's say NVIDIA, when it's trading, 100 some odd bucks, buying the 1,200 calls in NVIDIA for a penny, when there are much lower strikes if you wanted to buy them for a penny. So that kind of thing is strange. Activity that makes no economic sense. If you could buy a strike lower for the same price, then you should always buy that strike. It's kind of weird. We saw that in a lot of names over the past year. NVIDIA, Tesla, pick your poison. It's obviously risk management. It's kind of a hedging activity, but it's strange to see people just completely disadvantaging themselves from an economic perspective for no reason at all. But Dan, aside from that madness, which we'll talk about in some of our unusual activity year in review shows, and already have to a great degree. But Dan, do you agree with that theme for last year as well? Kind of a revenge of the meme stocks 2.0, if you will. And do you think that is to account for some of the resurgence of single name equity options volume we saw last year?
Yeah, I mean, yeah, we did see some of this meme stock resurgence. I'd go as far as calling it maybe meme stock 2.0, because I think it was a little different. And despite the fact that we saw some pretty weird decisions being made time to time, I think there has been some sophistication on the people who actually have been doing this for a while. So yeah, that was, I won't say it was surprising to see, because I guess it wasn't, but it was kind of fun to see how it played out.
It certainly was intriguing. I mean, I'm never going to get mad when people are going to bid up call skew in a name very generously of them for me so I can leg into verticals and other things at attractive levels. I'm never going to get mad at that, even if people are doing economic activity that maybe is not exactly to their advantage at the end of the day. But if it benefits our listeners, I'm not going to get mad at it, Dan. Other trends that were kind of interesting. Obviously, 0 day still strong this past year. That trend has kind of solidified itself now. Also interesting, Dan, one of the things people have been holding out against 0 day for the last couple of years, since they've really moved to the forefront, is that, you know what, we've never seen these things tested. We've jokingly referred to them as gamma bombs many times in the marketplace, but we've never really seen them in a massive sell-off day. How would they perform? Would they be the fuel that just lights the fire that destroys the market? We sell off, completely exacerbated by 0 day. We saw August 5th happen, Dan, and 0 day was in full effect. The volume kind of fell off a cliff that day, understandably. You're not going to be slinging a lot of high gamma contracts usually on a day like that. But the market survived, 0 day survived, and they persist in their volume. Dan, do you think that was a test that we needed to see to, I guess, cement the 0 day revolution taking over the options market, sir?
Yes. I'm going to give you a yes, but. I'm kind of glad that it happened, because it kind of let everybody see what is reality about the 0 DTs and what is not. And, I mean, I'd go as far as saying that move was a little bit exacerbated by a lot of the negative gamma that people had on, likely much of that being 0 DTE. But in the end, it was a blip on the radar, and these things happen fairly regular throughout the market's history.
That they do, listeners. You know what else happened? Kind of some interesting new products coming online towards the end of last year, and some of them not really new. They've been around for a while, but new for a lot of the U.S. audience here in particular. One of them, of course, the rise of, call them what you will, binaries or event contracts. Dan and I just did a whole show about this. Go check that out a few episodes ago if you want to sink your teeth into more binary/event contracts. Short version, listeners, these were the sole domain of international scammers not too long ago. We joked about the conferences in Cyprus for these things. Not exactly a hotbed of traditional finance, listeners. But this year, with some of the rulings we saw by Kalshi and others, taking advantage of that, the folks at IB launching ForecastEX, a lot of that solidifying around the election. Suddenly we had a big event everyone was interested in. That really strengthened a lot of the interest in all things binary. So, Dan, you think this was maybe a portent of things to come, if you will? We're going to have more binaries to deal with in the coming years, sir.
Yeah, I think that this was, I mean, they've been around for a while. So has, using them to gamble, if you will, on elections or whatever. But I feel like this was like the first real trial run where people were really even professionals, even the, professionals in the media were using these binaries as a trusted source of information. So, yeah, I guess this isn't really a prediction episode. Maybe we should do that next week. But I think that we're going to see a lot more of these binaries going forward.
Yeah, that does seem to be the way. I've been talking to a lot of people behind the scenes on the exchange and brokerage side, and they're all not idiots. Listen, they saw the volume and they saw the interest in these products, and they want to capitalize on that. So I think we will be seeing more products along these lines in the months and indeed years to come. Another thing, Dan, kind of happened towards the end of the year, but it certainly holds a lot of potential for the options market going forward. Weirdly enough, we had the approval of the Bitcoin spot ETFs in January of last year, but that meant nothing to the regulators. And for our audience who were waiting for the options to come online, they had to wait. They had to wait, and they had to wait some more through the summer into the fall. We didn't really get the options listed and traded until November 19th, I believe, listeners. So nearly a year later after the approval. Kind of wild, but IBIT came roaring out of the gate, Dan. Tons of volume. It is now one of the hottest products going day in, day out. 400,000 contracts, ADV. That is nothing to sneeze at in a new options product. So seems like interest in IBIT, at least for now, Dan, is here to stay. And it's always attractive to us to have a new, potentially liquid options market for our listeners to trade in. So, Dan, what do you think this means for the options market going forward, the rise of these Bitcoin and probably in the weeks and months and years to come, other crypto ETFs coming online from an options perspective, sir?
Yeah, I mean, Bitcoin doesn't seem to be going anywhere. And with the success of that contract, I mean, Ether and some of the other big ones are probably not too far behind, which just then in turn adds to the liquidity of it probably, because people will be, interclass spreading, buying one, selling the other. And if there's different size contracts or, not totally fungible contracts, but slightly fungible contracts, there'll be ARB opportunities, and all that stuff just creates more liquidity. So, yeah, I mean, it's not unlikely that stuff's going to continue to pick up steam.
That it will, listeners. Those are just a few of the trades and trends and developments that we noticed in the options market over the course of the past year. If you want more year in review breakdowns, we did it on Vol Views. We've done it on the Option Block, the Crypto Rundown, all the different shows. Advisors Option, I just did a good one with our buddy Mr. Matt from ORATS, looking back on the year from his perspective, vol and options and everything else out there, listeners. So there's a lot of year in review content. Dan, I was going to talk about our predictions from last year for VIX and our audience predictions and how they played out. But I think you made a good point. That might be a good thing to save for next week's episode. We could spend a lot of time looking forward into the market. So I think we'll table that for next week, listeners. But spoiler alert, I did pretty well on the VIX prediction from this coming year. Dan, not so much. Spoiler alert. But we'll reveal all those results. By the way, if you want to play along in that, listeners, our VIX official crystal ball for the year poll, our very popular guessing game, thousands of you played last year. Get over there at Options. It is live right now. You can make your voice heard and have a chance to win some fabulous prizes. Speaking of making your voice heard, let's kick off our first mail call of 2025.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get to it. Right now, I said this is live right now, so I won't go too much into it because Dan and I will give our full predictions for VIX next week on the show. So, Dan, you got a week to think about your VIX prediction for next year. But you folks are doing it right now. A couple of things you can do right now on the old Twitter at Options. First off, you can participate in our very spicy, very flavorful VIX range poll for the year. We gave you some flavor ranges to choose from. Where do you think VIX is going to close for the year? Is it going to be extremely spicy, aka the ghost pepper range, north of 20? Is it going to be more of a spicy, but maybe a little dialed back? Let's go a little spicy habanero, so 16 to 20 range. Is it going to be more of a mild buffalo end of the year, 12 to 16, or kind of a bland oatmeal sub 12 range? This has only been live for less than a day. Already a bunch of you getting your votes in. So get over there, vote in our poll, listeners. And then if you want to participate and be eligible for fabulous prizes at the end of the year, reply or DM to that thread with your exact prediction for the closing price for VIX this year, 2025. And we have a very demanding margin of victory. It's the same one we have on vol views every week, which is 1/10 of a point. Now, that sounds like a lot. Believe it or not, I was pretty close to that this year, and we actually had multiple winners from this past year. So it can be done. It sounds intimidating, but it can be done. Dan, not so much. A lot of other people, though, getting in there, including Steve Sosnick has been on network number 10. He got eerily precise in his prediction, which is kind of weird, but we'll get to all of that next week. But yeah, we had multiple winners, so reply to that. There can be multiple winners. That can be you. And for extra bonus fun, we also threw in extra chances for you folks to win fabulous prizes by guessing the VIX high and low closes for the year. So you get 3 data points. You get 3 swings at the bat to crush it and hit some fabulous prizes. Now, you got some competition. A lot of people chime in on this prize, but it's a fun contest. Get over there, have some fun. Are you a spicy habanero? Are you a ghost pepper? Are you more of a mild buffalo? Are you bland oatmeal? Hit us up. Let us know. Speaking of letting us know things, one of our final questions of the week we asked you last year. So the last time Dan and I were live on the show, listeners, we said, how are you positioning the equity? This is specifically for the equities, the equity portion of your portfolio for the coming year. And we gave you 4 choices. Are you going to have no change, markets only go up? Or are you going to start scaling back, maybe go to cash? Or are you going to stay long but hedge aggressively? Or are you going to pivot to something else? Could be crypto, gold, whatever you prefer there. And Dan, 45.2% said no change to their equity allocation. Markets only go up. They may be regretting that a little bit right now. Markets kind of having a rough start to the year, even though they have turned around now, it seems like, at least for today, up slightly on the day. 28.6% said they're scaling back, going to cash. 21.4% saying they're long but aggressively hedging. And about 4.8% saying they're going to pivot to crypto or gold or something else. Dan, does that surprise you? Are folks riding the equity train into 2025, sir?
No, I mean, not really. It's you need a catalyst for something to change, and I don't know, right now we don't have necessarily that catalyst as far, well, I don't know. I mean, we might start getting a catalyst over the next month or two.
We had some red catalysts over the last few sessions, that is for sure, even though the worm turning a little bit today. So listeners, stay tuned for that one, kind of fun. You know, speaking of fun, listeners, let's have a little bit of fun to kick off the year with our first market taker question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. Dan, I hope you remember how this works. This is where you regale our listeners with a question you've received from your community over there at Market Taker. So what you got for us to kick off the new year? Better be a good one. Set the tone.
All right. So should I ever hedge my long-term holdings? And the answer is, should you ever? Sure. But it should always be done very sparingly and very pensively. If you're like, oh, geez, I don't know, the market looks like it's turning around, I better, get short, a bunch of E-minis or, buy a bunch of puts or whatever. Or, geez, we were up 3 days in a row, it's probably going to pull back, I better, hedge. That's too much. That's what we call over trading. Me personally, like the amount I hedge is maybe on average 3 times a year, 2 times a year, maybe. And with some years not having any hedges, I'm not even sure if I did any hedges in 2024. I might have at some point, maybe in the beginning. So hedging your long-term holdings is okay, but only to be done very, very sparingly. Otherwise, you're just giving up upside.
So you start buying those puts. Dan smacks your hand away from the mouse. He says, no, get away from those puts. Get away from those puts to kick off the new year in 2025, listeners. Speaking of kicking off the new year, Dan, we have a question. I love when we get questions from our international listeners. I know we have listeners all over the world, and we've had questions from all over the place, India, Germany, you name it. I don't think Bulgaria has made that list till now, Dan. So wow. We've got a Bulgarian listener writing in. This comes from Dealer. I like the handle, Dealer. He had the bad fortune to send it in, Dan, right before the holidays. So literally the 2 weeks that we were off here on the show, because obviously Christmas and New Year's both falling on our show days. I'm not a monster. I'm not going to make Dan come in on Christmas Day and record a boot camp. Listen, I'm not that much of a monster. So no shows for the last couple of weeks, Dealer. So you had to wait a little bit. Thankfully, I did get your question answered already. I'll mention that in a second. But first, I will read his question, Dan. It's a fun one. He says, hi, guys. Greetings from Bulgaria. Well, greetings right back at you there, Mr. Dealer. He says, first of all, I would like to thank you for the OBC podcast. Really, really good show. Keep up the good work to enlighten people like us. I have learned a lot, but still the slope is quite steep. So Dan, he's loving the show. He's doing a little Larry David impersonation from Bulgaria with the really. I don't know. I'm liking Dealer. What do you think, Dan?
Yeah, man, absolutely. I love it. Bulgaria. That is our first one ever. That's really great.
Got to watch out, listeners. When we get new mail from foreign countries, Dan likes to show up on your doorstep. So watch out for you to knock on your door, Dealer. It might be Dan looking for some free lodging for a little bit. But he says, anyway, I got a couple of questions about options. Well, you sent them to the right place, Dealer. First off, implied vol. When looking into the chain for options series under the same expiry and strike, I can see different implied vols for calls and puts. Why is that? Shouldn't the implied vol be the same when looking at the call and put for the same expiry and strike? And two, we usually like to limit you to one, Dealer, but you're right in Info Bulgaria. We'll give you a doubler. He wants to know, is the rule of thumb correct? Dividing the implied vol by 16, you get what percent move the market is pricing for the underlying. Two great questions. One much more straightforward. Dealer, you know what? I didn't want you to have to wait. I knew we were going to be several weeks before we got another live boot camp on the air for you. So as it happened, your question came in right as I was recording a show with our good buddy, the Flow Master, Mr. Henry Schwartz, on the option block. And he is the guy who created the Trade Alert platform. It does a lot of the options chain pricing that you are specifically addressing in your first question. So we went deep into your question on that show. Henry actually gave you a very detailed and insightful answer. So hopefully you already heard that, Dealer. If not, I will make sure our editors cut that into the end of this show so you can hear it at the end of this show. You don't have to go looking for it, listener. The rest of our listeners here can hear it too. It's very insightful, but it gets into the nuances of dividend and the cost of carry. And that is why you're seeing that, quite frankly, Dealer. It's a little bit of a fudge factor that some of these platforms use to make everything else line up. So you're right. Theoretically, they should be the exact same implied vol, but because things are short sale restricted, all these things impact the cost of carry. That sometimes has to work its way into the model, and how they do that is a little bit of fudge factor that comes in by tweaking the implied vol on the puts. But we have a very detailed conversation about that with our good buddy, the Flow Master, who puts out these exact chains you're talking about. So we'll cut that into the end. I'll let you have a good listen on that, Dealer, and then right back in if you have more questions. But Dan, if you want to add anything on that about why he's seeing different implied vols, have at it. And then B, the second one, much more straightforward. He wants to know about the rule of thumb, dividing, I should say, the implied vol by 16 to get what percentage move the market is pricing in, sir. Have at it.
Yeah, well, since Henry addressed that one, that first one, I'll just skip down to two. So I'm always that guy when we talk about this subject. So the question is the rule of thumb correct? Dividing the IV by 16, you get what percentage move the market is pricing in for the underlying. Here's where I'm going to be that guy. No, the answer is no. The market implied volatility is not the volatility that the market's pricing in. Now, there is something to that statement, that implied volatility is the percent move that the market's pricing in. And I phrase it in a maybe overly decisive way because I want to challenge people to separate their brain a little bit from that oversimplification. What implied volatility is it's simply a measure of supply and demand for option prices. When there's a lot of buying, implied volatility goes up. When there's a lot of selling, implied volatility goes down. Now, the professor theory of it is that, well, everyone makes rational decisions when buying and selling options, and so they're pricing in future volatility fairly, but we all know that's not true. Like any behavioral economist would tell you that that's not true. And anybody who's traded options for a long time, I think, would also tell you that that's not true too, because implied volatility is always wrong to some degree. Because there's a lot of play in there. There's a lot of noise. So, and there's a lot of people who don't make completely rational decisions. So if I were just to give you the textbook simple answer, yeah, divide IV by 16. But when you listen to this show, you're getting the straight dope. You're getting the full story. The answer that I gave, I think, is more accurate and it'll take you farther.
There you go. Great question, dealer. Stay tuned for a lengthy discussion of your first question in a little bit. But yeah, Dan's right. It's not exactly, nothing's ever exact in the world. It's like delta being used as your probability of an option's expiring the money. It's not exact. You can use it as a fudge factor, though, in the absence of other things. I mean, a lot of this rule of 16 really got publicized by the SIBO, and they really were trying to get the VIX out there. They wanted to use it in relation to VIX. People have then since applied it to other underlyings. It's kind of a ballpark way to annualize something, right? Because you obviously 256 trading days, 252, 16 is the square root of that. So it's kind of a ballpark way to do that. Obviously, it's not exact, but interesting stuff. Unfortunately, Dan, that music means we have already come to the end of our first episode for 2025. And if folks want to reach out to you, Dan, to discuss the rule of 16 or just about anything else under the sun, where should they go? What should they do, sir?
Well, normally I tell you to come to the Market Taker website, but I want to make everyone aware of something new, and that is my Substack, which is, and it's kind of a long one, I apologize about this, but it's wealthbuildingwithoptions.substack.com. So wealthbuildingwithoptions.substack.com. Go there, and I share lots of different things that I don't share on the Market Taker site, including and especially a log and explanation of all my wheel trade adjustments in my IRA and such. So it's a different value proposition than what Market Taker offers you, and I think it's a good one. So please join us.
Look at you embracing that. Everyone's all over Substack all of a sudden. It's like that's another hot trend of 2024 that's continuing in 2025. You're on it. Russell's all over it. Rich Excel from our other things all over. Everyone's talking Substack to me all of a sudden. It's like it's 2018, 2017 all over again. All of a sudden, Substack. I got to get on Substack, I guess. I'm missing the trend here. So in the meantime, hit us with it one more time, Dan.
It's wealthbuildingwithoptions.substack.com.
Wealthbuildingwithoptions.substack.com. So if you didn't have enough outlets for Dan P's goodness, that's another one for you. Are you on the old Substack train, listening like everything old is new again? And Substack is coming back with a vengeance, listeners. Check it out. And while you're checking things out, check out our friends on this show, listeners, our friends over there at tastytrade. They're one of the reasons Options Bootcamp is coming at you here for the year that is 2025. So if you like what you hear, head on over to tastytrade.com/podcast. Tell them we sent you. They'll be happy to hear about it. We'll get some of those folks back on the show. They're always fun to rotate in, talking about their jade lizards and all sorts of other crazy wild strategies over there. That's going to do it for us on the old OBC today. I'm not going to do it for the network, though. Back again in a little bit, listeners, with our first futures rundown for the new year. Going to go deep into all things precious. No, not the One Ring, but gold and silver and precious metals. Should be a fun one, listeners, so stay tuned for that. Coming up in a little bit, if you're listening live, I'll be back in about 15 minutes or so. If you're listening after the fact, just hit next as soon as you're done listening to this show, and that should be there waiting for you on your podcast device of choice. Back again, of course, throughout the rest of the week. Not Thursday, of course. Thursday, the markets are closed. Back again on Friday, though, to break down the mad year and also the results of our 2024 VIX Question Palooza. Were you a winner? Did you play in our game? A lot of people did last year. Tune into Vol Views this week to see if you won fabulous prizes. Then we're back again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody. All right, listeners, we got some hot questions of the week. Make sure you get over there and play at Options and a bunch of other stuff you folks have sent in. But I want to make sure we save some time for this fellow who wrote in all the way from Bulgaria. We get a lot of international listeners writing in from all over the world. Bulgaria might be the first to put a pin on the map there. So congratulations to you there, Mr. Dealer. He says, hi, guys. Greetings from Bulgaria. First of all, I would like to thank you for the podcast. Really, really good show. Keep up the good work to enlighten people like us. I have learned a lot, but still the slope is quite steep. Oh, keep it up, Dealer. You're ahead of the game already. You're listening to shows like this. He says, anyway, I got a couple of questions about options. First off, implied vol. When looking into the chain for options series under the same expiry and strike, I can see different implied vol for calls and puts. Why is that? Shouldn't the implied vol be the same when looking at the call and put for the same expiry and strike? But I think having the Flowmaster on, this first one is a good one for you as well, because you're out there putting together a lot of these options chains and this data that people are seeing. Mr. Flowmaster, our friend from Bulgaria, is confused why he's seeing different implied vol levels for calls and puts on the same strike, sir. Set him straight.
Well, it's great that he's studying it, and that's the right question. And, theoretically, we all know like a call can be a synthetic put. So it actually does kind of have to have the same volatility. But what ends up happening, especially in single stocks, is if there is a difficulty in borrowing the shares, so if it's a hard to borrow name, that's equivalent to having a dividend. And it needs to be basically taken out of the interest rate. And if you don't take it out of the interest rate, so that borrow cost, what you end up is it appears that the call volatility is lower than the put volatility. So now a lot of traders just get used to it and they get comfortable with that, and they actually use it as a signal that this is a difficult to borrow stock. But what I would suggest is if you put those two options into an options calculator and then start changing the borrow rate if that's a parameter, otherwise just start changing the interest rate because it's kind of equivalent, you'll actually be able to get those two volatilities to line up. And that's actually a trick that we use on the for SIBO theoretical values, and other vendors do it as well, is you do want your volatilities to be the same for calls and puts. There really is only one volatility for a given strike and expiration. So what you end up doing is effectively trying out different borrow rates until you get to the level where those two vols match, and then you actually know where the borrow is priced, and you can actually compare that to what it costs in percent to short the stock, and you should see a connection there. They're not going to necessarily be the same because you have differences in duration, but if something is costs you 15% to short it at your broker, then that actually would go into the input for a borrow rate, and then all of a sudden your call and your put volatilities will match.
There you go. Those divvies and short borrow rates always gumming up the works out there, and a lot of single name. Yeah, whenever you see this kind of discrepancies, chances are the rate is to blame out there. But great questions, Dealer. Looks like you're ahead of the game. You're selling yourself short. Thanks for taking the time to write in all the way from Bulgaria.
Options Bootcamp is brought to you by tastytrade. Ready to shred your paper trades? Then trade at tastytrade, the broker that gives you what you need to make your own way. Get smarter every day with options education and research tools. Analyze your risks clearly with a potential profit and loss graph. Chart your way with hundreds of indicators. Make the numbers make sense and find the opportunities only you can see. Trade it with fewer clicks on an easy-to-use platform. Mobile, desktop, web. Supported by a trade desk with decades of combined experience. Stocks, options, futures, and more. You choose, you trade. Get what you need to make smart moves. Go to tastytrade.com/pod to see for yourself, genius. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.